Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this week's video, we'll discuss how investors can handle market swings amid the current rotation out of large cap tech stocks and into areas such as small caps. The next few months could also experience more uncertainty due to the presidential election and upcoming Fed rate cuts. Investors should keep these factors in perspective and remember that the market experiences new all-time highs as well as pullbacks throughout the course of the business cycle. Over the next few minutes, we'll highlight the key facts that investors should stay focused on in the coming months. First, this chart shows the performance of large cap stocks like the S&P 500 in gold and small caps, the Russell 2000, in red. Indexed to zero in 2015 with the shaded blue area showing the cumulative spread. As you can see, large cap stocks have outperformed due to technology stocks and the AI boom. However, large caps have pulled back more recently as growth and technology sectors have struggled. Small caps have outperformed in recent weeks as investors have shifted into these stocks instead. Why has this occurred? For one, investors have been wondering when this AI rally was going to take a breather for quite some time. There are new concerns about whether the billions that large cap tech companies are pouring into AI will generate a sufficient return on investment. Additionally, small cap stocks tend to be more sensitive to rate cuts and domestic growth. For all these reasons, investors have shifted from large caps to small caps, at least for the time being. This rotation is a reminder to investors that they can benefit from being diversified across styles and sectors, rather than focusing only on what happens to be outperforming at the moment. Next, this chart shows quarterly GDP growth for the past 4 quarters, with the growth broken down into percentage point contributions by each major category. In the second quarter of the year, the economy grew robustly at a rate of 2.8%. While some parts of the economy have moderated, consumer spending, shown here as personal consumption expenditures, and business investment, shown as gross private domestic investment, have remained strong. This corroborates other economic data, including strong jobs gains and improving inflation. In fact, recent inflation data show compelling evidence that we are slowly returning to a more normal environment. Finally, this chart shows the total returns and pullbacks of the S&P 500 over the past few decades. The bars represent total returns and the red dots mark the levels of the largest intra-year declines each year. The largest intra-year decline can be measured as the steepest peak to trough decline for the index during that calendar year. This shows that even though most years experience significant intra-year drops, they still tend to end up in positive territory. This is a good reminder that volatility is a normal part of investing, but over time, investments can also generate income. It's important not to overreact to market pullbacks or all-time highs because they're both a normal part of investing. We hope that you found these high-level insights helpful. If you would like to ask any questions or like to discuss any of these topics in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.